Vanderbilt Business Live. I'm Eric Johnson, and I'm here today with Professor Richard Willis. Welcome, Richard.
Thanks a lot, Eric. I'm glad to be here. Thanks for the opportunity.
Well, Richard's research focuses on security analysts, firm disclosure, shareholder litigation, and recently he's been delving into corporate tax behavior. So we're here to chat a little bit about corporate tax behavior, specifically avoidance. What does tax avoidance look like for corporations, Richard?
Yeah, sure, Eric. So we measure tax avoidance. We get the firm's statutory tax rate, which would be available from the government when the country, for the firm in the country where the firm is domiciled. And then we compare that to the taxes that the firm is paying, and we calculate that from the publicly available financial statements. And then we compare the two. And so if the statutory rate, which is the required rate, is higher than the rate that we calculate, we interpret that as consistent with tax avoidance. And we're careful to note that this just means the firm is paying less in taxes than we would expect, but we're not alleging any illegal behavior.
But you do find a nice little political element. That is, your studies show the impact of political uncertainty on corporate tax avoidance in election years. What do you find?
Yeah, absolutely. That's right, Eric. So my co-authors and I actually have two studies, and both the studies were compiled based on a global sample of thousands of firms domiciled in over 30 countries around the world. And the first study, which is the one you're asking about, political uncertainty, we do look at corporate tax behavior leading up to national elections in the country in which the corporation is domiciled. And we find that in election years, companies pay less in tax than in non-election years, which we determine that is consistent with the political uncertainty arising from general macroeconomic uncertainty about tax policy changes potentially effectuated by an incoming or new administration, as motivating firms to hold more cash in expectation of that future uncertainty. And the way that they hold more cash, one of the ways, is that they pay less in tax. So that's the first paper. And then the other paper, which we also look at using a global sample of firms in over 30 countries, we look at changes in governance that are instituted at the country level, where the governance mechanisms are made to be a little bit more strict. And there's a couple of ways that that's done. It's either a mandated change that a regulatory body imposes, or the company would be in a firm where they have to make the change or explain why they don't. And those changes in governance would be things that governance advocates advocate, such as greater independence of the board of directors, separating the chief executive officer duty from the chairman of the board duty so that the board can better do its oversight. And we find in that case that when firms are domiciled in countries with stronger governance, that they avoid less in tax. So in summary, for political uncertainty, we find that firms avoid more in tax. And when governance mechanisms are improved, we find that firms avoid less in tax.
Interesting. Well, certainly this has been a issue of public debate in the last couple election cycles, and I'm sure not just here in the U.S., but all over. But what motivated you to look into this?
Yeah, you're right. We do see this. We see this around the world. We looked at press clippings from around the world. Both the studies are really motivated by the same fundamental economic question, which is better understanding the factors, the features that affect firms' tax avoidance behavior. And that's a very important issue for us because taxes are a significant source of government revenue, and also governance advocates, capital market participants as well, are very interested in tax avoidance behavior.
Well, thanks so much, Richard. Really appreciate it. And thank you for watching Vanderbilt Business Live.